A very hearty welcome to Ved Jain sir from SIRC, sir. Sir, I am Secretary Pannaraj speaking, and I'll straight away hand over to you just by giving a small brief introduction about you for those who do not know you, or most of the people but me knowing being past president of the institute. I'll take pleasure of welcoming the erudite speaker, second speaker for the day, Ved Jain sir, by introducing him. And he is from New Delhi, has been a man of prudence, veracity, and intelligence since birth itself. Academically very brilliant, and is a rank holder both at inter and the final CA levels. A triple bachelor degree holder. He completed his Bachelor of Science from Punjab University in 1973. A fellow member of the Institute of Chartered Accountants of India for more than 3 decades. On 5th of February 2007, he was elected by the Central Council as Vice President and was further elevated to the post of the President on 5th February 2008. During his tenure as President of the ICAI, he has earned various credentials which embark a new era of professional development. His integrity, zeal, and commitment towards the profession and society has been recognized and appreciated by the Government of India. Immediately after his tenure as President of the Institute of Chartered of India, he was assigned the job of reviving, managing, and the 2 associate companies of Satyam, and was appointed government nominee director on the board. He successfully managed these companies and revived the same. He is regularly involved in the consultation process of the Ministry of Finance and Ministry of Corporate Affairs, and members of various expert committees or panels constituted by the Government of India for fiscal and commercial legislations. He has more than 4 decades of experience on advising corporates and on finance and taxation matters. Mr. Jain specializes in direct taxes and has handled complicated tax matters, appeals, and tax planning of big corporates also. A prolific writer, having command in Hindi, English, French, Urdu, and Punjabi, has authored many books on direct taxes and regularly contributes articles in various journals, newspapers, and frequently participates in various television debates, programs on economic, finance, and tax issues. With this illustrious career, sir is before us, and we are very fortunate to have you here, sir, today. Thanks to pandemic, which has made the technology possible to reach you out at your place, at your doorsteps. Thank you, and once again, welcome, and over to you, sir.
So you're muted, sir. Sorry.
Muted.
I hope now you can hear me. My voice is clear?
Yes, sir. Yes, sir. Audible and clear, sir, please.
Okay. Good evening. Thank you, Mr. Pannaraj, for that compliment and the introductions, so elaborate introductions. And good evening, friends, all my brothers and sisters from the southern regions which are part of this program. I may compliment to the chairman SIRC for extending invitation, giving me this opportunity to share my views on this Finance Bill 2022, which is the part of the Budget 2022 exercise carried out by the Finance Minister. Friends, as the Secretary, Mr. Pannaraj, was saying, pandemic has its own plus and minuses. Minuses are that we are tied down to our home, we are not able to meet physically, we are missing what we call pleasure of interacting and getting more and more information. But as a blessing is that we are able to reach out to large number of people. This has given us a new lessons to learn, and the Zoom communication, other communication that becomes so easy that one can access and one can communicate with anybody sitting any part of the world. And that's why I'm in Delhi and I'm able to interact. I think most of you sitting in different part of the southern India, I can see roughly more than 800 participants in today's program. And maybe in many in Chennai, maybe in Cochin, maybe in Bangalore, or maybe at different places, which is there. Friends, my today's topic is mainly related to taxes. And that budget gives an hope to everybody that something you should get out of this budget. Budget 22 was not an exception. Before this budget, was announced on 1st February 2022, everybody was making hue and cry, I should get this exemption, I should get this deduction, somebody should raise the standard deduction, threshold should be increased, once say ATCU investment deduction should be increased, housing loan deduction should be increased, businessmen are crying that you extend our exemption, grant us a deduction, and the startup are also saying exempt my income, multinational companies saying, yeah, you are taxing too much, take care of us. Everybody was saying like this. That was a scenario which is going around, and it is not unnatural. Everybody want to get something out of it. But when we look at the budget exercise, I think we as professional, as chartered accountant particularly know that at the end of the day, budget is a balancing exercise. It is like a trial balance where debit and credit has to match. Similarly, budget is an exercise where income and expenditure had to meet. There cannot be any gap in that. And some of you may be knowing, and just for the knowledge of the sake for sharing with you, budget is an exercise where expenditure is first estimated and then the resources are mobilized to meet that expenditure. Somewhere in the month of August, September, the finance ministry writes to the various ministries to give an estimate of the expenditure which they are likely to incur next year. Maybe capital, maybe revenue, maybe whatever the account it is. And looking to the past experience, etc., an exercise is completed whereby an estimate of expenditure is prepared. And meanwhile, resources from where this expenditure is to be met are worked out. It is only in the month of December end and January beginning where a matching exercise starts, that this is the estimate of the expenditure and this is the income which we are having, how to meet this. How do we go ahead with like and work it out, plan it out on that basis. And this exercise is the most difficult exercise. And then pruning is done in respect of expenditure, some pruning is done in respect of income. At the same time, some resources are to be mobilized. If some concession is to be given, some pruning is to be given in the income tax, obviously that collection will go down, and through that extent, some resources have to be found out. And that's why the most important question for all of us to ponder over is that a concession given to one will be at the cost of a tax to somebody else. Now, if you look at the budget of this 22-23, some of you would have the chance to look at the receipt budget. The Government of India has projected 14,10,000 crore rupees as a likely collection from the income tax for the next year. If Government Finance Minister gives a concession to a tax clause, say if we increase the threshold from 2,50,000 rupees to 3 lakh rupees, 50,000 rupees, which is subject to tax at 5%, and 2,500 rupees benefit goes to every person. And if I multiply this by my 6 crore taxpayer, and considering that out of 66 crore, 50% will be taking this, will be falling in this clause, the immediate revenue loss will be 12,500 crore rupees. And if this reduction is to be worked out from the total estimation, something has to come up from somebody else. So that is the difficult exercise which is carried out. And that's why I'm saying that this budget at least has given credibility and stability by not extending any further exemption and deduction. This may not look good to many taxpayers who were expecting it, but look at it from a perspective that had this concession been given, somebody else would have been required. India has passed, I will say the entire world has passed through very difficult pace, still going on for the last 2 years. We are passing through unpredictable scenario in the future also. The finance minister could have levied extra taxes to mobilize the resources. So I gave an example that one should be thankful to the finance minister that she has not levied any extra taxes as against giving any concession. There can be two ways to look at a glass which is half empty or half full. You may say that it is half empty. Why it should not be full? I should get more exemption or more deduction. The finance minister says, look, gentlemen, this is half full. I would have half empty. I haven't made you full empty had I levied more taxes. That's a plus point, I believe. In that scenario, I believe this budget has given a credibility and stability, and very progressive budget, I will say, which is laying down the roadmap for the next 25 years, and next 3 years are going to be crucial. The way the government has projected the capital expenditure, if it is going to actually be implemented, I believe the scenario of India may change drastically, generating more employment, more opportunity, more infrastructure, and with a boom in the economy which is there. That's a scenario. In this background, now we'll look at the nitty-gritties of the various amendment which has been proposed. One thing I was wondering, when finance minister didn't make any change in the tax rate, etc., I was just wondering what will happen in case he has not made any amendment to the income tax act. People would have been happy, but what I would have done as a speaker speaking before you, I need to speak 1 hour before you. Mr. Panaras, how much time I have?
So we can have till 7:15. 7:15.
Another 40 minutes I will work it out.
Yes, sir.
Just I will work it out in my lecture library. So now what would have happened? If she would have said the way she said there is no change in tax rate for anybody, she could have said no amendment in the income tax act. But she can't do it. She knows people like us, speaker like us need something to survive and make some amendment. And she was kind enough, I will say, to put 84 amendment in the income tax act, despite no change in tax rate. For me to speak, at least if somebody want to speak at least 3 to 4 hours, I can take 5 minutes, 10 minutes for one clause, and 84 into 5 will become 4 hours, 5 hours. That's amendment which she has made on this part, and that's what scope she has given to me to speak about. Now coming to one by one, what is there? One is the tax rate. Though absolutely there is no change in the various tax rate and slab for individual HF, etc., but there are 3 changes which to be noticed. One, long-term capital gain was being subjected to the normal rate of tax. We all know individual HF, AOP, BOE, etc. are taxed at a graded scale. We have a tax rate, and so the surcharge also increases with the increase in the income. If you have income up to rupees 50 lakh, you are not required to pay any surcharge. If your income goes up from 50 lakh to between 1 crore, you are liable to pay 15% surcharge on your tax liability. If your income is more than 1 crore, on the entire income tax liability, you need to pay it. Sorry, from 15 lakh to 50 lakh to 1 crore, 10%. From beyond 1 crore or beyond 1 crore, you need to pay 15%. And beyond 2 crore, you need to pay 25% surcharge. And beyond 5 crore, you need to pay 37%. Looking to the FII's demand, last 2 years back, she has reduced this surcharge from 37% to 15% in case of a dividend income and in case of a long-term capital gain arising from the listed security. So all FIs were happy. But there was a concern that why it should not be applicable to all long-term capital gain. And the reason being obvious, because long-term capital gain, though taxed in 1 year, because asset get transferred in that year, in fact, it is an income aggregated, accumulated income of over a period. It is not in 1 year. It may be 2 year, 3 year, 4 year, 5 years income which get taxed in 1 year. So taking into consideration that fact, she has reduced the surcharge to 15%. So irrespective of the fact whether your income is more than 2 crore or not, you will be liable to pay 15% surcharge only. So that's a big reduction which has come, a benefit in respect of all long-term capital gain, not only listed share security, any share, any security, any asset, capital asset, maybe land, building, whatever it is. So that is a 15% rate. Now, what we need to learn as a professional? Now, having announced that this rate will be 15%, but will be applicable from 1st April 2022. So those people who are contemplating any transfer of a capital asset and the capital gain is likely to take their income beyond 2 crore rupees, if they do it now, they will be liable to pay higher surcharge, maybe 25% if it is beyond 2 crore, and beyond 5 crore, 37%. To avoid this, if they can postpone this transfer to 1st April onwards, then their liability will be, surcharge will be 15%. This is the message which one can get it. Another small change which she has made is about AOP, Association of Person, because AOP are also bracketed in the same category as individual and HF, and surcharge applicable on them is also 37%. But many AOPs which do carry out various infrastructure projects in collaboration or as a joint venture consisting of companies, they say that our company get taxed at a lower rate, but when we do the same business as a AOP, then why there should be a surcharge of 37%? taking into consideration this aspect, a small concession has been given for AOP consisting only of companies. All member of that AOP should be companies only. Then surcharge will be 15%. But in case any one out of them is not a company, then surcharge will be the normal 15, 25, 37 as the case may be. So this is a benefit for joint venture, etc., where all companies join. Some concession for cooperative society where MAT has been reduced from 18.5% to 15%. That's a small concession which has been given. And the fourth change when I was talking about is in respect of the tax rate applicable on dividend income received from a foreign company by an Indian company where it is holding 26% or more share in that foreign company. You will all know there is a section 115 BBD which was introduced way back in 2012, encouraging Indian companies subsidiary outside to declare more dividend and bring money back to India. You will know, I appreciate it. When a company earns income, it is required to pay tax. When income is distributed by the company by a dividend, then only it get taxed. The company is not forced to pay dividend. So if any Indian company is having a subsidiary company in UAE and where it is earning substantial income, so long its entire share may be held by an Indian company or an Indian person, that income will not be chargeable to tax, neither by as a tax and dividend, because dividend is not distributed. So in 2012, the then finance minister Pranab Mukherjee said, I want to encourage those companies to distribute maximum dividend and bring back to India. And that for that purpose, 115 BBD was introduced to levy tax at the rate of 15, concession rate of 15%, and so that more and more money can come back to India. Now in this Finance Bill 2022, it has been proposed that this 15% tax is a distortion, because when 15% was levied, then dividend distribution tax was there, and there was no liability to pay tax on dividend income. Now, since dividend income is being taxed in India at a full-fledged rate, so there is no reason why it should be concession rate. So section 115 BBD will not be applicable after 31st March 2022. So any Indian company, irrespective of the fact whether it is holding 26% more than share in that company, any dividend received from that company after 1st April will be applicable at a normal rate, which can be 22% or a 30%, where the case may be applicable to the company, plus applicable surcharge and education cess, etc. So this is another change. And the lesson from the message from this is, in case you are having a foreign subsidiary company or a company outside India where you are holding more than 26%, it has got accumulated profit as on date. It is better to declare dividend and get back that dividend before 31st March 2022. In case you bring back that dividend, it will be under the old law, which is continues to be applicable till 31st March 2022. After 31st March 2022, it will be 30% or 22%, whatever it is. This is the message which or maybe then you don't declare dividend. That's the only issue. These are the changes which have been brought so far. What I consider is relating to the tax rate only. Now I come to few exemption and reduction. Salaried people were asking for so much benefit, whatever it is, maybe even medical reimbursement, etc., but that has not been given. But government has kept one promise which they made by a press release in the June 2021. You will all recall at that time an announcement was made looking to the second wave, which was a very strong wave, giving exemption to employees in case any expenditure has been incurred for treatment of COVID of the employee or any family member of the employee. Now that expenditure will not be considered to be a perquisite by the employer in case it is. Further, in case any financial assistance has been given to the family member of the deceased employee, that will also not be considered to be a perquisite. This press release was there. Now to give effect to this, amendment is being proposed in section 17(2), where in perquisite it said it will not be considered to be a perquisite. Here, for the purpose of this, family member include only those family member which are part of section 10(5). You know section 10(5) talks about the leave travel concession. So leave travel concession is eligible for the family member of the employee also. So in this definition, spouse, children, parents, brother and sister, if they are wholly or partly dependent on the person. So only those people in this they are getting this amount. And for this, there is no limit and ceiling where employer-employee relations come. Similar amendment has been proposed in section 56(2). We all know that under section 56(2)(10), any person receiving from any other person any amount or any property other than from a relative where the value exceeds 50,000 rupees, then that becomes income from other sources liable for tax in the hand of the recipient. So in case any person has received any medical treatment or any compensation or a relief from any other person, that would have become taxable. But this budget says that any person has borne expenditure for a treatment of a COVID for any person or has given a financial aid to any family member of a person who had deceased because of the COVID, then 10 lakh rupees will not be taxed. Now, the language of the section is little difficult, which says in case it is 10 lakh or less, but idea is to give exemption up to rupees 10 lakh. I believe when the budget is passed, finance will come for consideration finally. Ultimately, up to 10 lakh rupee exemption will be there. In case it is beyond 10 lakh rupees, then that part will be taxed, but up to 10 lakh exemption will be given. In case it is receipt from relative, which is falling within the meaning of relative, then there is no issue, that will be fully exempt. But in case you have received from a non-relative, then up to 10 lakh rupees exemption will be there. So these are the two parts regarding exemption and deduction. Third, maybe a smaller part only, 80 CCD, we all know, contribution to the NPS. In case central government contributes on behalf of the employee, there is no ceiling. In case of other employees, there was a ceiling of 10%. Looking to the hue and cry being made by state government employees, now contribution by the state government and central government without any ceiling will be exempt. But in the case of a private employees, it will continue to be 10%. Frankly, I am of the view employer-employee relationship is same whether it is central government employee or state government or a private sector employee. If central government is eligible to contribute up to 14%, which it is contributing and which is considered to be exempt, there is no reason why a private employer contribution should be restricted to 10%. It should be 14%. You can say because central government contribute 14%, so it should be 14%. That's a distortion, discrimination, which should be avoided in tax law, mainly because you are sitting in power and you can draft the law and you put a higher figure and don't give them to other without making any issue why it should not be 14%. That's a discrimination, I believe, that need to be resorted. So these are the changes. There is no change so far salary income is concerned, and there is no change so far income from house property is concerned. Now coming to the business income, there are 4 major changes which may be relevant to you. I will just discuss on that part. One is section 28(4). This section was amended 12 years back to provide that any benefit or amenity if you have received from the business, then that will be considered to be income of the business. Because what was happening, many distributor, many dealer, many retailer were getting gift, holiday packages, visits to foreign destination, etc. from the company of which they happen to be distributor, dealer, etc. Some going to Bangkok, some going to Hong Kong, Singapore, London, UK, etc. Holiday package, etc. or some expensive gifts were being given. That was made that such perks will be taxable in the hand of the business which is receiving it. But now the government says, having made a provision, but we are not able to control it because we do not have the information. In order to keep a control, now a new section 194R is being introduced in the Tds provision to provide that whosoever is giving such benefit or amenity to the dealer, distributor, retailer, etc., he will be required to deduct tax at source at the rate of 10%. And in case the total amount of the worker benefit exceed rupees 20,000. Now, this will be requirement, and in case because all these are being given in kind, it is being further said in case it is in kind and maybe difficult to deduct that amount, then he will ensure that this amount get deposited. And how it will get deposited, that he will collect from the dealers or distributors. So need to be paid distributor. Exclusion is that in case there is an individual and HF, and in case its turnover is less than 1 crore rupees, or a professional whose receipts, gross receipts are 50 lakh or less than 50 lakh rupees, then this provision will not be applicable, as other provision of TDS are not applicable. Then there is a change in section 37(1). We all know under section 37(1), expenditure incurred wholly and exclusive for the purpose of business is eligible for deduction, unless it is not a personal or a capital expenditure. Then there was a explanation 1 inserted to provide that any expenditure which is incurred, which is prohibited by law or which is an offense, then it is not eligible for deduction. So far, so good, because that is good. Now, there has been a controversy erupted whether an expenditure incurred by a pharma company in giving gift, etc., to doctor is considered to be prohibited by law or is an offense. Now, there were some contradictory judgment on that part, because Medical Council of India has said that they should not give, and they have said that this is against the code of conduct. Code of conduct is a moral code of conduct, and that should not be, it is not a law, but still the law. Now, taking cue from the few of the judgment which are favorable, this bill provide that not in one more explanation 3 has been inserted to explain explanation 1. There is section 37, there is subsection 1, there is explanation 1, and now there is explanation 3 to explain section explanation 1. For the purpose of explanation 1, the expenditure incurred shall be considered to be prohibited in case such expenditure is prohibited by any code of conduct or professional ethics, etc. Or composition money or expenditure is such which is prohibited or which is law or offense or law of any country outside India also. So in all 3 situations, the expenditure will not be allowed. The nutshell is that compounding fee paid with composition money, compounding fee paid will not be eligible for deduction. Expenditure incurred on doctor, etc., which under the medical council, etc., are not allowed or code of conduct is violation, that will not be eligible for expenditure. And any expenditure which is an offense or prohibited by law of any outside country also will also not be eligible for exemption. Third issue is regarding education and health and education cells. We all know that there is a section in income tax under section 40A2 which says while computing business income tax paid is not an eligible deduction. I hope you all know about it in context. Now, in 2005, the government levied education and health cess. Now, in the last 3-4 years, a controversy has erupted whether this education and health cess can be said to be an income tax so as to be disallowed under section 48(2) of the Income Tax Act. The Bombay High Court in the case of CA Ved Jain Limited held that it is not a tax to be considered under section 48(2), and if it is not an income tax, then it will be eligible for expenditure incurred for the purpose of business. The judgment, Chambal Fertilizer judgment of Rajasthan High Court also endorsed the same view. But recently, Kolkata bench of the ITAT analyzed all the judgment, and they got hold of an old judgment of the Supreme Court in Srinivasa case, where the court has held that surcharge, etc., they are also part of the income tax. And on that basis, they distinguished the judgment of the Kolkata High Court also, Bombay High Court as also Rajasthan High Court. Now, taking cue from that, this finance bill has proposed that education and health shall not be eligible for expenditure, and the judgment of Bombay High Court and Rajasthan High Court are per incurium, and that's why an amendment has been proposed, which will be retrospective in effect from assessment year 2005-06, meaning thereby now education and health cells will not be eligible for a deduction, and this deduction cannot be claimed on that part. So this is the nutshell of this provision on that part. Now I can switch over a little bit after this because there is no other amendment regarding capital gain. I switch over to this cryptocurrency or virtual digital assets, which is another controversy which was going on and which this budget is trying to settle down, because that will take a part of my other income from other sources also. As we all know, cryptocurrency has become more popular, and there has been a phenomenal growth on this part. Some debate was going on whether it is legal or illegal, whether Government of India should prohibit or not prohibit. And once the bill was ready to be introduced in Parliament, it was stopped, and then the government said we want a larger discussion. Now, in this finance bill, it has been proposed that any income arising from the transfer of a cryptocurrency, which they say virtual digital asset, will be liable for tax at a special rate of 30%. under a new section 115BBH. It is just like 115BB, you may be knowing, 69A, there is a special rate of 60%. So in line with this, a new section 115BBH has been introduced, notwithstanding anything contained, any income on the transfer foreigner. It has been further provided that no expenditure will be allowed against this. Whatever is the sale proceed, that will be done, only the cost of acquisition will be deducted. In case you incur any loss, that will not be allowed to be set off against any other income. In case you have loss, that will not allowed to be carried forward. So meaning thereby, whatever you have paid for purchase of that coin or that what we call cryptocurrency or asset, and whatever the sale price you have, difference will be liable for tax at the rate of 30%. I'm of the opinion in the same year, if you have loss and profit, then both can be adjusted. Though there can be a debate on that part also. But I am of the opinion that it is the income only can be taxed. And in case you have made a profit or loss, if you have made a 10,000 profit in one, or if you have made a loss in another, then difference can be worked out on that basis. But still there can be a debate on this one. But the challenge will be that in case on 29th March, you have incurred a loss of 8,000 rupees. On 2nd April, you have made a profit of 10,000 rupees. Since the year has changed, you will not be able to adjust because loss is not allowed to be carried forward. So meaning thereby, I am of the opinion that same year it may be there. Similarly, in reverse, if it happens, then again it will be the same issue. You will not be able to eligible to set off the losses on this. Now, in order to bring transparency and have an audit trail, a new section of TDS 197S is being introduced, putting an obligation on the purchaser to deduct tax at the rate of 1% at the time of payment or credit, whichever is earlier. Now you need to deduct on this issue, and that there are two thresholds for the purpose. One is 50,000 rupees for specified person and 10,000 rupees for other than specified person. In case you are a purchaser, you are not carrying on business, or if you are carrying on business, your turnover is less than 1 crore rupees, or if you are carrying on profession, your turnover is less than 50,000 rupees. This obligation to deduct TDS will not be applicable in case you are making payment of less than 50,000 rupees. But in the other case, it will be 10,000 rupees only. So 1% has to be deducted and paid on that part on this issue. There may be challenges now that how you will make from whom you will deduct. You are purchasing on an exchange, and how you will deduct an exchange. Now there will be a challenge whether you will deduct of exchange or the person you may be knowing or not knowing, that may be challenge. I may just say clarify that these provisions per se do not legitimate or legalize investment or purchase of this cryptocurrency. As a resident, one is liable and one is under obligation to comply with the FEMA law. So you cannot make any purchase outside India without through authorized dealers, etc. So you have to have, in case your rupee payment ultimately lead to flow of exchange outside, there can be a violation of the FEMA law also. If you are doing within the India, then there is no issue, I believe in this. There may be a debate whether it is legal or illegal, that's a separate issue. But I am of the view the only controversy which has been settled is that it will be liable for 30%. This provision will be applicable from 1st April 2022. So what will happen is till 31st March, it will be taxable at a normal income. Don't believe that this is not taxable up to 31st March 2022. Because under the income tax law, a resident is liable to pay tax on his total income irrespective of the source. And no exemption is there, and all income is liable for tax unless there is a specific exemption under the Income Tax Act. And in the Income Tax Act, we all know there is no such exemption to anybody from tax on this part also. So on that part, the tax will be required to be paid even up to 31st March 22. There may be a debate up to 31st March 22 whether I should consider as a business income, a capital gain, or income from other sources, but it will be liable to tax at a slab rate. If you are filing a slab of less than 10 lakh rupees, you pay 20%. If you are filing beyond 10 lakh rupees, then 30%. That's the only issue which is there. One thing more which has been taken care of is that one can make a gift in cryptocurrency also. So in keeping that in mind, 56(2)(10), which provide any gift from a non-relative, is liable for tax. The definition of property is being widened in section 56(2)(7) to include virtual digital asset also as a property. So anybody who receives this cryptocurrency from any other person free of any amount or any amount which is less than the fair market value of that asset as on that day to be computed, and that difference is more than 50,000 rupees, it will be deemed to be the income of other sources, income from other sources of the person who is receiving this. So these are the amendment which has been made and proposed in this part. So this is on the for the part of the cryptocurrency. Now there is another provision which may be of interest is section 68. We all know section 68 talks of cash credit, puts an onus of the person in his books any amount is found credited to explain the nature and source. In 2012, and proviso was added in respect of share capital and share premium, and putting an obligation in case SSC is a company to not only explain the nature and source of the shareholder from where the money has been received, but also nature and source of the shareholder from where he has received. So that was the obligation which has been put. Now the scope is being widened to putting an obligation, loan and similar borrowing, if any money has been borrowed, which is found credited in the books of account. Not only the nature and source is to be explained by the SSC, but nature and source is also to be explained by the lender or the person who has given the money from where he has got this money and how he has paid this money. This is an extra obligation which is being implemented from 1st April 2022. There is no exception on this part, and the proviso has been worded in a negative way that in case nature and source is not explained, then it shall be deemed to be income of the credit. Now the problem is that there is no exception even for bank, for NBFC, etc. If you take a bank loan also, say from State Bank of India or a Indian Bank or a Canara Bank, now bank will be required from which source you have given the money. But loan has been given. Though intention is not there like this, but the language which I say is like the 68. Then there is another amendment in section 94. We all know section 94 is an anti-tax avoidance provision. And there is a subsection 7, which or subsection 8, which talks about of dividend stripping and unit stripping. You believe there's many in the mutual fund, there used to be a dividend stripping that you buy unit which has a book value at 20 rupees today, and tomorrow that dividend is declared by that mutual fund, say 10 rupees, its value goes down, and that 10 rupees used to be exempt, and if you sell the unit later on of 20 rupees at 10 rupees, you have to get a loss. In order to address this issue and to address the issue of a dividend which a company come dividend and next dividend, you have bought a share of 100 rupees and tomorrow dividend is declared at 10 rupees. So amendment was made in 94.7 and 94.8 that in case you have made a purchase within 3 months from the date of book closure and you have sold it within 9 months after the book closure, so any income which you have received in between which is exempt shall be deemed to be reduced, cost shall be reduced to the extent the asset which you are selling within the 9 months. So it was a dividend stripping measure which was introduced. Now 3 years back, government has introduced InvITs unit, which is called investment unit, and REITs. You might say, we have seen that various developers have promoted Brookfield and this in Bangalore, Shobha developer, etc. They have issued this InvIT. They are units where you receive regular income and there can be a dividend stripping type mechanism there also. Same is being done in bonus share of a listed companies also. You buy a share of State Bank of India today at 100 rupees, and tomorrow State Bank of India declares a bonus 1-for-1, and then later on third day you sell the share at 50 rupees because the share has become after bonus value at 50 rupees. Then 50 rupees the loss which you have incurred on the original investment, and your bonus share value is 0. In order to address this dividend stripping, bonus stripping, this finance bill proposes that in case there is a bonus stripping also, then that loss which you incur will not be allowed, but such loss will be considered to be the cost of the bonus share or the units. If I can give you an example, in the present case, if you have bought a share of 100 rupees and there are 50 rupees, and this share has been purchased within a period of 3 months from the date of book closure. Say today is 3rd of February, and you buy share today, and State Bank of India declares bonus, and we say the book closure will be on 31st March 2022. So your purchase is falling within 3 months. And then if you sell share within 9 months, that before 31st December 2022, and the share rate at that time is 60 rupees. And since you have bought 100 share, 100 rupees, and you are having 1-to-1 share, so your 100 shares are at 100 rupees, 100 share at 0 rupees. So if you sell 100 shares which you have bought earlier of 100 rupees, selling at 60 rupees, you will incur a loss of 40 rupees. But that loss will not be allowed and will not be set off. But this 40 rupees will be considered to be cost of your bonus share, which is zero value cost. So you will be eligible to do that. I believe this is the restoration of the earlier judgment which Supreme Court has given before this amendment was made, where they said that bonus value, share value will be taken zero, looking to the complexity. In Anarkali, judgment is there of Supreme Court, which is a famous judgment, which has laid down the law how to value the share, bonus share, in case bonus has been declared. At that time, it normally was if you are 100 share at 100 rupees and then bonus is 1-to-1, 200 share value is 50 rupees. That was the judgment with the Supreme Court. Similar was the right issue on Anarkali. But government later on said that we cannot keep a track like this. We will keep original cost at the original cost and the bonus share zero value at zero cost. Now we are going back on the track same way of Anarkali judgment. That's a 94. Having said so, now I change gears and I go to 2-3 provision which are procedural provision. One is section 139(1), which deal with the provision of filing return. We all know that under section 139(1), we are supposed to file the return by the due date, which happened to be 31st July or 31st October or 30th November in TP cases. Then we all know that in case we have not filed the return in 139(4), we used to have the right to file the return before the end of the assessment year. But after the amendment, the period has been reduced to 3 months before the end of the assessment year, which means 31st December. Then there used to be a period for revision under 139(4). After filing the return, you find out any omission or failure to correct the return. There used to be earlier 2-year period from the end of the assessment year. It was reduced to 1 year, and now last budget has reduced it to 3 months before the end of the assessment year. Meaning thereby, in the same assessment year, you can do whatever on the part of now. But thereafter, there is no right to file the return of income. Now, government has thought that some mechanism has to be given for correction of the returns. And they have found out a new way, update your return. And you can update your return within a period of 2 years from the end of the assessment year. You can update your return within a period of 2 years from the end of the assessment return. And then there is an obligation put on you. Who can do it and what will be the cost? First, what will be the cost? They say whatever is the tax, interest, etc., after inclusion of additional income that you need to pay, but on that amount which you have to pay, 25% extra you need to pay if you are updating your return within 1 year from the end of the assessment year. But if you are updating it after 1 year, but within 2 years, then you need to pay 50%. Huge cost. I'm just wondering, earlier I was having a right to revise within 1 year or 2 years. It is the same mechanism. There is a revision of return. And I was supposed to pay tax and interest only, nothing more. You have curtailed the period, but you have brought the period back in other form, asking me to pay 25% more or 50% more. That's the mechanism which has been worked out. But after 2 years, nothing you can do, no issue. Then it will be a 147, 148, that procedure. And now, what are the conditions? Who can file or who cannot file? There are conditions. In case your case has been done, assessment or reassessment has been done, or it is pending, then you are not eligible to do it. In case search has been carried out on you, then you are not eligible to do it. A survey has been carried out, then you are not eligible to do it. In case a notice has been issued to you under PMLA or Benami Act or Coffee Posa, then you are not eligible. If a prosecution has been launched against you, then you are not eligible. There are lots of conditions apply on this issue. But this is one of the provision which has come up, and probably the idea is that the new procedure of reassessment where 148 notice is to be issued after inquiry. So their idea is that in case when we issue a notice for inquiry that we have got this information, it will give an option to you to come back and to file the return and to do correction on that part. So these are the provisions which need to be looked into, and one mechanism has been created. Looking at time constraint, I am not going into much nitty-gritties on that part. So that's one scenario which has been created on. Second is the faceless assessment. For the last 3 years, faceless has become a new word for the income tax department. They started with e-assessment. They introduced a faceless assessment scheme by notifying a scheme. Then they introduced 144B provision last year, and now this year they are revamping it. And on top of it, in all earlier scheme, they have said, we may or may not give you an opportunity of physical hearing. And that matter was under challenge before the courts. The courts have taken a very harsh view that this is not done. But one interesting provision was there, 144B9, which is say that in case you have passed an assessment order in violation or by not following any of the procedure prescribed in section 144B, that order will be known as. Now look into the two harsh provision, that order will be known as and there will be a violation of the procedure. We all know assessing officers do commit mistakes, etc. while doing assessment. Now that 144B9 is being deleted. And in place of existing 144B 1 to 8, new 144B provision has been introduced. And the major change in that provision is only one, that now as a matter of right, physical hearing through video conferencing had to be given. In case any assessee taxpayer wants any physical hearing through video conferencing, it has to be allowed. It will not be an optional. This is a well-settled principle of natural justice. Supreme Court and Appellate Court have reiterated a number of times. You cannot condemn a person without giving a hearing, just on the page of paper. So my suggestion to all of you will be that when any notice, any scrutiny notice or any other notice comes up, the last sentence of each your letter should be, please allow me a personal hearing through video conference. I hereby seek a personal hearing through video conference. This should be your template of every letter you write to the department in response to any notice, so that you don't miss it out. As we write now in the last, thanking you, yours faithfully. Before that, the line should be very clear. I hereby seek a personal hearing through video conference. That should be letter, so avoid any content, because the law is clear. In case you don't seek, then he is not obliged to give you a hearing on that part. So this is the amendment which has been made on procedural part of the amendment. Then there is another amendment regarding the income escaping assessment, reassessment, etc. Last year, the entire scheme was changed. Consequent to that, notices issued after 31st March have been quashed by various high courts. I'm not aware of the judgment from any southern India high courts, but Allahabad High Court, Delhi High Court, Rajasthan High Court, Calcutta High Court have already quashed notices on that part. Chhattisgarh High Court, of course, has gone against on that part, and SLP again, that is pending it. So that's a separate part. The new procedure is, I'm not going into. But this time, there are 2-3 amendments which may be relevant to part it out. One is, earlier there was, before issue of a notice to you, approval was required. Now that approval has been withdrawn, which was rightly done, because there were earlier 4 approvals, which now get restricted to 2. Before issuing an inquiry, he will have to issue a notice, or he has to seek an approval. And then second, before passing an order, he has to seek an approval, which will be fair enough. But the main problem is, last year, we all know that before last year, that department has a right to reopen the assessment for up to 6 years. In case 143.3, then were 4 years, subject to certain conditions, and then 6 years, up to 6 years, beyond 6 years. And in last year budget, a specific explanation was inserted that in case that in order to reduce the period of litigation, ease of doing business, bringing more confidence in the taxpayer, we are reducing the period for reopening the assessment to 3 years, and beyond 3 years, it will be reopened only when we found any assets beyond 3 found any income escaping assessment which is represented by assets, and then example of assets was also given: bank balance, securities, property, etc. Now a U-turn has been taken in this bill 2022, providing that beyond 3 years assessment can be opened not only when income escaping assessment has been represented by assets, but also where expenditure has been incurred for any event or something like this, or also where entries or on the basis of income has escaped assessment on the basis of entry or entries in the books of account. Now I wonder, if basis of entry or entries in the books of account and expenditure is subject matter of reopening assessment, in all cases this allegation will come up, because at the end of the day, for income escaping assessment, there has to be some entry in the books of accounts. So in the moment the amount exceed, only threshold will be that 50 lakh will be helpful only. And in 50 lakh also there is a catch, where the income likely to exceed, actual income may not be more. So even if there is allegation 40 lakh and assessing officer believe that it is more than 50 lakh, then you can reopen the assessment. This is the major change which is being proposed in 147, 148. I will say the new provision, which was introduced in 21, still to be applied, but before application we are having a U-turn, taking a U-turn on that part. So this is another change which is coming up on that part. Then there is some change in 156. I need not refer to on 156, where because of IBC merger, demerger, any demand get waived off, etc. The assessing officer will have a right to write off the demand and issue a new demand notice. 156A is there. Then we have a 158BA provision which provide for keeping the litigation in abeyance in a similar issues pending. So instead of that, a new 158B provision is being introduced, whereby in case a favorable order has come in favor of an SSC or of High Court, Supreme Court, or similar order is pending, something like this, then a collegium can decide not to file an appeal against the order of the CITA or against the order of the tribunal to the High Court in similar issues pending after obtaining a consent of the SSC. I am of the view, frankly, why the SSC will give a consent? When a favorable order is already there of a higher court, let the department file an appeal and get it dismissed. At the end of the day, it takes 5 minutes in case the favorable question of law and the similar has been decided, so quickly it gets disposed of. On the contrary, the benefit may come up because of the tax effect. The department will not be able to go to the higher forum. If the CIT appeal has decided an issue and department want to go to the tribunal and issue is covered by the judgment of tribunal in your favor, and department files an appeal in tribunal and that get disposed of in your favor because tribunal has already given and demand is between 50 lakh to 1 crore rupees, the department cannot go to the High Court. I don't think why it is. And then it is a collegium. Our experience with DRP has not been happy. We all know 3 commissioner sits and by and large relief is not given on one pretext, because 3 people are not able to reach consensus, or secondly, department does not have a right to file an appeal against it. And in case we give a relief, department will lose the right to file an appeal. Surprisingly, and in many of the cases, even the High Court, Supreme Court orders are not being followed. This is one this issue. So these are the changes which have been proposed on that part. Then there, I'm skipping in between. Then I go to 194 IA. We all know any person who's buying a immovable property other than the agriculture land, if the consideration is 50 lakh rupees or more, than 1% TDS has to be deducted. So now this Finance Bill 2022 is proposing that this 1% is to be deducted higher of the two, that is actual consideration or the circle rate, what we call the local rate value, circle rate of that area, whichever is higher. So in case circle rate of the property which you are buying is 50 lakh or more and the consideration is 45 lakh rupees, then you need to deduct TDS. In case circle rate is 45 lakh rupees and actual rate is 50 lakh, 2 lakh rupees you are buying, then you need to deduct TDS. But if both are below 50 lakh rupees, then you need not do it. But take care, no discount of 10% which is available for purpose of 50C or 56 to 10 is available in 194 IA. You have to deduct irrespective fact whether it is within 10% also. Still you will have to deduct TDS. Suppose the circle rate is 53 lakhs. You have bought for 49 lakh and it falls within 10%. Then you have to deduct on 53 lakh rupees, 53,000 rupees. That you have to deduct 1%. You cannot say that it is not required to be deducted because it is within 10%. So this is the 194I amendment on that part. Now there are some other consequential amendment in section 79, 79A, 179, 179 about merger, demerger, etc. Looking to the time constraint, so I can skip it part. And in case you have a question answer session, we can take some question answer. What is the program now? It is 7-6. So I leave it to you. What should be done? I can explain few more clauses, or I can skip on that part?
So we'll go up to 5-10 minutes, then we'll take up few.
One thing I have forgotten about the charitable trust. I think I just touch upon 5 minutes of charitable trust. So I think maybe charitable trust or institution which get exemption under section 1023C or section 11 or 12 are always on the hit list and radar of the income tax department. I could not make out why they are so harsh on this charitable trust institution. All these NGOs are rendering a valuable service to the society, and there is no reason to be harsh with these institutions. But I don't know why. What is the thought process? And this budget also have at least 35 pages in the memorandum making various amendments to the charitable trust society. There are so many clauses amending one after the other to charitable trust society. I will just summarize 510, which are the major changes which are being proposed. They say 1023C is one regime, 1112 is second regime. Both are having different provision. Let us try to converse and merge bigger. And in that process, they have made the situation more complex. First thing, now they have noticed that both 1023C or section 11 both have provision for audit, but both do not have a provision to maintenance of books of accounts. Now amendment is being proposed that all these trusts, the society, etc., beyond the threshold, which audit threshold is there, they will be required to maintain books of accounts. This is the first change which they have proposed. Second change, in case assessing officer does not give you exemption, he says that you are not eligible for exemption for one reason or the other reason, how the income is to be computed of a charitable trust institution? This is the second question. They say whether the gross receipt or any deduction for expenses should be allowed. Now they say no. We will say gross receipt minus expenses incurred for the purpose for object of the society. That we will allow you. But 4 conditions we have to fulfill. Any expenditure which has been incurred out of the corpus will not be eligible for deduction. Any expenditure which has been incurred out of charity and donation will not be eligible for deduction. Any expenditure which has been incurred by taking loans or borrowing, that will not be eligible. Depreciation shall not be allowed in respect of any asset which has been considered for as application of it. These 4 conditions will be applicable in both cases, 1023C and 11 and 12. Secondly, while computing income, provision of section 40A3 will be applicable. Provision of section 40AI will also be applicable. 40A will also be applicable. So meaning thereby, no deduction of TDS you have to fail or cash payment, etc. That will also not be paid. The third controversy was that what happened in case I have not spent 85% of expenditure and I was entitled to accumulate it. For section 11-12, there was a form 10 which you were supposed to file and you can accumulate 5 years. For 1023C, there was no such requirement. Now for 1023C also, there will be requirement that you need to file a form 10 for that purpose for accumulation. Another controversy was that in case it is 5-year period, whether tax is to be levied after the expiry of 5 years or in the 5th year. As per the present provision interpretation under section 11-12, it was after the 5 year, that is 6th year, and in 1023C, it was the 5th year. Now, taking cue from this controversy, they say it will be the 5th year, so you need to spend by 5th year. But if you don't spend by 5th year, then within the 5th year, it will get taxed on that part. That's a change which has been brought on that part. Now, another change is for temple, masjid, gurdwaras, mosque, etc., or that purpose. They all received contribution, voluntary donation, etc. They need to identify the contribution or donation they have received for repair of this like this, whether it is a corpus or whether it is not a voluntary. Wherever they identify, then they have to incur that expenditure only for that purpose. And they cannot use that amount for any other purposes. That's another obligation which comes. Another change is wherever the commissioner has the power to cancel the registration, and while canceling the registration, he has to take a decision within 6 months from the end of the quarter in which the notice is issued. This is another requirement part time. Where assessing officer recommend to the CIT, then assessment order can be kept in abeyance, and that period will get excluded, during which the CIT takes a decision about cancellation of registration. One positive change is there. There is a section 13(1)(c), probably you know. Section 13 puts an obligation that conditions to be complied with by a trust or society who get a registration under section 12. And they say benefit of section 11(12) will not be available in case you violate any of the conditions. And 13(1)(c) is one condition whereby in case any benefit has been given or to any person, settler or a office bearer or a relative, an amount has been paid beyond the reasonable amount for which he is entitled to, then that amount is not eligible for deduction. Our view was it is not eligible for deduction, but department contention was that once you violate this, then you lose all benefit and you are not eligible for exemption, and even registration used to be cancelled. Now, in order to settle this controversy, now it is being said that in case there is a violation like this, the amount which is in excess of the reasonable amount will be deemed to be the income of the person who has received it, and that income will be liable for maximum marginal rate, like cryptocurrency under a new provision after cryptocurrency 115 BBI. Cryptocurrency new section is BBH, it is BBI. So the person who has received, he need to pay maximum marginal rate tax 30% plus surcharge, whatever applicable, on such excess amount which he has received on the beyond. I believe whatever he has received, he will be paying a normal tax. On this, he will be 30% plus. On top of it, there is another provision. Trust will be required to pay penalty. A new provision 271AA is being introduced on the total amount so paid, 100% penalty if the default is in the first time. So in 1 year you have paid and that default is there, in that whatever amount you have paid excess, then 100% penalty will be levied on the trust or society. And in subsequent year the same default is there, then it is 200% of the amount. It is not tax of 30%. If you have paid a salary of to one person 6 lakh rupees, and AO says that he is not entitled for 6 lakh rupees, entitled for 2 lakh rupees, 4 lakh rupees will be the penalty, and 4 lakh will be liable for 30% there. Subsequent 8 lakh will be the penalty. But the plus point is exemption will not be denied. I believe that is a relief which has come up on this issue. So these are the various provisions which have been introduced on that part, and these are the various provisions. I have tried to explain it. So now I over to you, I believe, Mr. Panaraj, if he's there, and
Yes, sir. Yes, sir. Thank you, sir. Thank you very much, sir. Now we will take up the queries.
The screen visible, sir. Excel sheet. So from second, yes.
now these are the questions which you have put on the screen.
So these are the questions that came up, sir. From second question onwards, we'll take it up. Sir.
What is the limit of 1 crore under section 194R is for provider or receiver?
Receiver.
This question is provider. The obligation to deduct tax is on the provider. In case a provider is an individual and HCF, that it is only the provider who provide it. What about the input tax difference which we can claim before next September and restriction imposed? I believe this is regarding GST, I believe, indirect taxes.
No, question, sir.
So Prasanna Krishnan, if you want to take it on that.
Oh, yeah, you can complete, then I can add, because it will be intervening. Your flow is nice. Happy to hear musically.
All right. How 48(2)
Yeah.
can be made retrospective when it is clarificatory in nature as far as cess is concerned? No, Parliament has a right to make a retrospective amendment. You cannot parliamentarize. Only thing arises is when the legislature says that this amendment shall be clarificatory but is effective from 1st April 21 or 22, then it is not retrospective. But here the bill itself is saying that this amendment is retrospective and shall have effect from 1st April 2005, effective from assessment year 2005-06. So then I don't think there can be any dispute about that. This will be a retrospective. Can monetary support provided to the family of the person deceased due to COVID pandemic, a non-employee, as usual, will be claimed a deduction from the business income. I say no. I think that cannot be done. In case it is non-employee family, in case he is a family person of the employee, then it will be 37 because you need to cross the hurdle of 37(1). Then it will be like a charity which you are doing it. I will suggest to go to CSR for this purpose rather than on this purpose. Whether income from virtual asset is subject to tax after applying slab rate or is it taxable? I said now up to 31st March 22, since there is no law on that point, it will be slab rate, but beyond after 1st April 22, it will be state 30% from ₹1. Whether the term loan or borrowing under Section 68 and term money under Section 16 are two different concepts. Section 16A source is not mandated. No. 68 is a credit in the books of account. 69 and 69A are the investments. So investment from undisclosed sources which you are not able to explain. So these are two different provisions. So the moment you will say this 69 that I have received this money from some other person, then it will get converted to 68 and otherwise not. The language of section 139(8) does not restrict filing updated return for earlier years, say 17-18. How this is possible to file before 31st March 20, especially when the assessee plan to escape? See, this provision will come into force. It is not in force today. This provision will come into force on 1st April 2022. And this provision gives you an option of filing a return for 2 years from the end of the assessment year. So on 1st April 2022, you will be in a position to file return only of 2021, and you cannot file of 1920 assessment year because 2 years would have ended by on 1st April 2022. Sir, suppose I filed the revised return for assessment, can I still file updated return for the same as per law? I think as I gave you example, 21-22, you will be in a position to file the revised return. No, you can file the return today also for assessment year 21-22 because the period stand extended because of the COVID. 31st March, I think the period available to you under the present law also. But in case you are not willing today and you want to take the benefit and go do charity to the government by paying 25% extra, you are welcome to do it up after 1st April 2022. COVID expenditure or COVID treatment during assessee be able to take deduction now. I think that's a lacuna which has come up because there was a press release. We have advised people to claim deduction, but in case you have not claimed deduction, I will suggest to file a revised return. Over to Prasannaji for this question of third question.
Thank you, Vijay. That's a sharp point actually. As we had discussed, the amendment relating to this 2B section 37 are all prospective. We are just waiting from the date of enactment only it is going to come. It's not retrospective. As far as September 2021 referred here is concerned, what you are referring to is 2021 financial year, which could have got the extended time for setting right or claiming your IT differences and all till September 21. That remains as such without any disturbance. If your 2B is not showing or what to do it, 2B was not a criterion at all till September 21 or even today also. Recently only 2B is coming to the importance for the financial year 21-22. Okay, so that's the case. If you are having 2A supporting you, if you are having invoice in your hand, if you have got your services or goods received duly evidenced, maybe with the EWB supporting you, bill supporting you, perfectly you can claim credit. 2A is a great supporter for you, go by that one. 2B is not at all relevant for September 21, as I had explained in the discussion.
Yes, more questions are over, Selva?
Those are questions.
Yeah.
Any fresh questions? No, right?
No.
There is a possibility of seeing the viewers who are having an interaction one-to-one with the viewers, or no possibility? Nobody can raise.
So there is no possibility for them to unmute and turn on the camera. This is a webinar pattern.
Even audio is not possible of the viewers?
No, sir. They're joining in a browser. So those who are joining in a application, they might unmute and speak. We'll try to unmute them.
All right.
So, shall we wait?
Yes, sir. So we'll take up.
Okay. Okay, sir. Thank you very much to both of you, Ved Jain sir and Prasanna Krishna sir, for your time and your experience and your presentation in such a lucid manner, making the things very clear to the members. And if at all there are any queries, they will mail you. If possible, please respond to them. So this, from SIRC point of view, we are done with this today's program. Even though it is a repeated program, more than 800 members joined today's program. Yesterday it was by Vaidishwaran sir on indirect tax and Bhupati sir on direct taxes. And we knew this many would not have attended. So we repeated the program equally. Yesterday also around 800 people were there. And I thank each one of the members who have participated in this discussion, made use of this program. And we are really happy to see that so many members are benefited with this program. And you are the reason, and your inspiration and support is the cause for our conducting programs of this nature. So, but for the time and efforts of the commitment of the stalwarts like Ved Jain sir and Prasanna Krishnan sir, such programs would not be possible. So with folded hands, I thank on behalf of SIRC and all the viewers here for your time and your exchange of your experience on this.